Overdrawn director's loan accounts explained. If you're a UK director who pays yourself in dividends and your company has started to struggle recently, please watch this video until the end. Not doing so could put your company extra tax of bloody 33.25%, or it could even mean you're losing your family home. Serious stuff this. In this video, I'm going to explain to you exactly what an overdrawn director's loan account is, what causes them, what are the consequences of them, and importantly, how you can deal with them without losing your home or it costing your business an absolute fortune. My name is Chris Worden and I am from Director First. Now, let's talk about what an overdrawn director's loan account is. Right, if you imagine every business has a ledger, and when a director puts money into the business, it goes as a credit on the ledger. Every time it takes money out of the business, it goes as a debit on the ledger. And at the end of the year, your accountant will file your accounts, and based on the profits of the business, they will declare a dividend out of the profits. They will convert your drawings on the debits to a dividend out of the profits, and as long as you've made enough profit, you do not have an overdrawn director's loan account. But if your business starts to struggle, let's imagine, right, for years and years, let's take 50 grand a year, right? You take 12 grand a year through the salary scheme and you top it up another 3 grand a month through drawings. And you've been able to do that every single year with no problems, but the last year you've started to hit the skids. Your business is either isn't making any profit or isn't making the profit that it used to. It's highly likely that your business can no longer afford to pay you the amount of dividends that you've come to rely on. And what happens is that causes an overdrawn director's loan. Another area that causes director's loans is where there's a lack of documentation. So a director might be using informal transactions, doesn't really keep receipts. He's paying bits here, paying bits there, but it's not documented that it's for the business, and the accountant puts it onto his overdrawn loan account or her overdrawn loan account. So remember, keep your receipts, keep your invoices, give them to your accountant when they want them. Now you know what an overdrawn director's loan account is, I'm going to tell you where you can find yours. So you may be able to see it in your accounts, but the problem with your accounts is your accounts are generally not up to date. So you might have done accounts for last year or 18 months ago, but if you go through those accounts, your director's loan account may be in assets. It might say current assets, other debtors, overdrawn loan, director's loan account, director's advances. And that'll show you where your director's loan account was at the last time that you did your set of accounts. But the problem is, since your last set of accounts, a whole lot of stuff will have happened. Let's say you've got another 12 months of drawing since your last set of accounts. It's highly likely that overdrawn loan account that you had in 2023 is now higher in 2024, especially if in 2024 you've continued to make less money than you was in 2023. So where will you find it out? And this is why this is really important in insolvency, is you're going to be asked to repay that director's loan back by an insolvency practitioner when you're in liquidation. So what you can do is you can check your Xero, QuickBooks or Sage or whatever accounting software that you use. I've been using, a couple of clients have had Free Agent recently that seems quite good. That's not a plug for Free Agent. But what happens is, on these accounting softwares, you're able to pull off a balance sheet or a trial balance. And on that balance sheet, it'll show whether you've got an overdrawn loan account or not, on the basis that you keep it up to date. If you don't put the right information into these softwares, they're about as much use as a chocolate tea cozy, okay? I had one the other week. The guy sent me his Xero logins and his cash balance sat at 1.3 million. Now this guy had never turned over 1.3 million, so God knows how it came there, but I'm like, I can't do anything with this. It's useless. Now, if you've not got that right and your accounts are out of date, it might be a worthwhile idea to get a final set of accounts done from your accountant. If you're at this stage, it's time to talk. We need to have a chat. I'll speak to your accountant, tell them what we're looking for, because at least if they do that final set of accounts, it gives you a clear picture of where that overdrawn loan account is at this stage. And I'm going to come on to it, why that's important. Because what are the consequences of having an overdrawn loan account? Well, let's imagine you're not going into liquidation. And let's explore the consequences for the company if you have a large overdrawn loan account at the end of the year. So to avoid unnecessary tax charges, it's crucial that you repay your overdrawn loan account back into the company, regardless of the balance, within 9 months of the company's year end. Because if you don't do this, within that period, the result, listen to this, you get charged an extra 33.75% S455 tax that goes on your corporation tax. It's colossal. So if you don't end up in liquidation, you're going to give your business a whole load of problems with a bigger tax burden. And remember, your business is starting to struggle. This is the things that tips businesses over the edge. Now, if you do end up in liquidation, the problem is an insolvency practitioner is going to have to chase you for it, okay? That's what they're there to do. An insolvency practitioner, you've got to remember this, right? There are some great insolvency practitioners out there, and I'm not one, right? I am not an insolvency practitioner. My job is to focus on you, the director, first, and get you the best outcome that we can in a really challenging time. Now, I only work with licensed insolvency practitioners who are fantastic. I've worked with them for years, but their job is to realise some funds for creditors and collect assets of the business into the pot to distribute them out to people who you owe in order of preference. Now, what people don't realise is an overdrawn loan account is an asset of the business. You have taken that money out of the company and you owe it back. So you appoint a liquidator is duty bound to try and get that money back from you, and that's the problem. And what's an even bigger problem is most directors don't even know that they've got overdrawn loan accounts. Never mind that an insolvency practitioner is going to ask them to pay back the overdrawn loan account if they go into liquidation. It's where we're a little bit different. We get all the crap out on the table on day one so we can work our way through things. Now, resolving directors' loan accounts, this is the really important bit. Once you've found out whether you've got one or not, it's important to have that conversation with the liquidator. Dear God, please do not leave this till after the fact. You've got to get this deal done with them up front. Now, formal agreements can be agreed with insolvency practitioners before you decide to appoint them on how you can settle your director's loan accounts. You will be able to get time to pay the director's loan accounts, and in almost all cases, you'll be able to negotiate a settlement. So let's say you owe £100,000. You won't have to pay £100,000 back in most scenarios. I'll tell you how they look at this. An insolvency practitioner is going to look at three things really. Have they got a right to act? Now, if you've got an overdrawn loan account, that's a tick box, they've got a right to act. Not only have they got a right to act, they've got to try and recover some funds. That's their job. But number two, have they got a hope of recovery? Listen, if you're in rented accommodation and universal credit, they have got no hope of recovery. If you've got £1 million pad with no mortgage, they have got a hope of recovery. Now, let's say you've got no available equity, you don't own your own property, you have very little money. At that stage, an insolvency practitioner is likely to write the director's loan off because, point three, who's going to pay the legal costs? If they have to start litigating against a director to recover funds, somebody's got to pay those legal costs. And if you've got nothing to lose, if you've got no assets, no ability to pay, who in the right mind is going to spend another 10, 15 grand chasing you through the courts in solicitors' fees? No one will. They don't tell you that, but they won't do. Even if you're at the £1 million end of the scale, and you've got loads of equity in your house, you're still going to get some type of discount on this director's loan as long as you pay it relatively quickly. I can assure you. Most people are somewhere in the middle, where they've got a house, they've got a mortgage, they're married, they've got half the equity, they've got credit card debt, and all around this scale, a deal can get done. And the idea is to show them what you can afford, what type of your personal position is. But the key thing is you've got to bring this to the forefront. And you need advice around this. Please, if you're worried about a director's loan, pick the phone up to us today. Chris Worden, Director First. We offer free and independent advice. It's something you cannot leave to chance, because this is what happens on a bad day. A director goes out there. He's searching around for the cheapest liquidator, because that's all he thinks it is. He thinks it's like buying buying just a normal consumable. What's the best deal out there? And he chooses a liquidator. He calls me and I say, listen, I'm £4,000 plus VAT, but you've got a director's loan account and it's going to cost you 30 grand to settle it. And he goes to someone else who goes, oh no, we'll wrap this up, sir, for £3,000 plus VAT. And they'll go, what about my director's loan that funny bowl chap with specs talks about? Oh, don't worry, we'll cross that bridge when we come to it, sir. And then he goes into liquidation and they cross that bridge and he's round his throat for all the money. And he starts legal action. Because once you've appointed a liquidator, they've not really got any motivation to do a deal, because the more they chase it, the more they can bill. They're expensive. You must get the director's loan account dealt with firsthand, okay? A bad one could be around your neck for years. You could lose your home. It could cause you serious, unnecessary pressure. I'm not saying you can sweep this under the carpet. You can't do. But if you've got a house, you've got equity in your property that needs protecting, as long as you work with someone like me, we help you understand your position. We go to one of the insolvency practitioners and say, listen, this is what they can afford. This is the evidence to show that they can afford it over this period of time. We can get you 6, 9, 12 months to pay a settlement on your director's loan. I got one organised yesterday at 15p in the pound. He owed £80,000 and he's because of his personal scenario, he's paying back 15p in the pound over 10 months. So there are solutions, but you've got to be careful. You've got to dot all the I's and cross all the T's. So I hope that this has been helpful. I hope you understand what a director's loan account is. I hope you understand where you can find it. I hope you understand what could happen if you don't deal with it. And I hope you can understand that there are always solutions, but you've got to take advice. My name is Chris Worden, Director First. Thank you for your time.